Hello, everyone. Thank you for joining our second quarter update of our long volatility fund. My name is Thomas Kummer, and along with me is Daniel German. Before we jump into the performance updates, the positioning and the outlook, please allow me to give you a brief update on the fund. Currently, the fund assets stand at 28 million. We continue to see good interest for the strategy and expect strong momentum to continue. As a firm, we manage roughly 150 million in volatility strategies out of the 800 million total AUM. The strategy delivers convexity and aims to deliver protection diversified across asset classes and regions. It's implemented in a carry-neutral way, and currently we are invested in 8 different strategies or funds. The investor base of the fund consists of a Swiss pension fund, family offices, and wealth managers. Due to investor demand, we are about to launch a hedged Swiss franc share class for the fund. Along with that, Progressive Capital will further increase its treasury allocation to the fund. In terms of activity, next week we will be participating at the Pension Bridge Asia Conference, where we will introduce the strategy to the Asian institutional investor base. At the beginning of September, we will hold a webinar on long volatility for all members of the BAI, which is the Bundesverband for Alternative Investments in Germany. In terms of HR, Michael Peterhans joined the team as an analyst with focus on credit protection and other diversifying strategies. Furthermore, at the beginning of August, we will strengthen our operations team by an additional person, bringing the company team total to 15. With that, let me hand over to you, Daniel.
Thank you, Thomas. Now let's have a look at the performance so far year to date. So year to date until June 30th, we produced a plus 17.1% net. That's in US dollar for class I for the fund. And that's in the context of the MSCI World being down 20.5% and the Bloomberg Barclays Global Aggregate Bond Index down 9.1%. We also significantly outperformed the relevant strategy benchmarks. So our fund's 17.1% positive net return compares to plus 6.6% for the CBOE Eureka Hedge Long Volatility Hedge Fund Index, for instance, and to a plus 9% for the HFRI Macro Total Index in those first 6 months of the year. The first quarter was positive with plus 10.2%, the second quarter as well with plus 6.3% net, and 5 out of the 6 months have been positive, meaningfully so, mostly with 3 to 4%. And there has only been one negative month, which was May, with a minus 0.8% return. As you can see on this chart, it's been a fairly steady rise in terms of the fund NAV. There has been only minimal downside standard deviation volatility of the fund and only minimal drawdowns so far. And we also, as you can see, significantly outperformed the HFRX Macro CTA Index, which is the red line here on the chart. And of course, the MSCI World Index, which has been drifting lower fairly steadily, which is the light blue line here. Our performance in those first 6 months since launch of the fund has been almost a positive mirror image of this negative MSCI World performance so far. Now, if we look at the performance in slightly more detailed for those first 6 months, with a weekly frequency, we see that in terms of this chart, the red bars reflect the weekly returns of the MSCI World, and those have been sorted from most negative single week returns, which is on the left-hand side of this chart, up to the most positive single week equity returns, which are on the right-hand side of this chart. And as you can see on this chart, the fund, which is the light blue bars, has been fairly reliably positive in basically all negative equity weeks, which have of course dominated this year so far in terms of frequency. And then when you look at the positive MSCI World Weeks on the right-hand side, we tended to be down, but only relatively moderately down. And sometimes we have even been up when equities have been up as well. And that ends up in terms of statistics that we actually, whenever there have been negative MSCI World Weeks, we had an average performance of plus 1%. And whenever there were positive equity weeks, we had an average performance with the fund of minus 0.3%. So that's about the 3-to-1 positive asymmetry or ratio in terms of upside downside capture, and is exactly what's part of our convexity target with this fund as well. And that, of course, then adds up to this positive year-to-date performance in combination with the frequency of negative equity weeks, as mentioned. If we go to the next slide, we look at the actual attribution of this performance. And then here we see that in this first part of the year, the top contributor have been implied volatilities, namely long positions in implied volatilities across asset classes, meaning across FX, rates, and equities. And those long implied volatility positions contributed a total of plus 6% in those first 6 months. Another major contributor in the first half of the year have been credit protection strategies, with a positive contribution of 5.6%. The third major contributor so far this year have been active equity trading strategies with a short bias, contributing plus 5%. All other strategies have been positive as well in the first half of the year and contributing a combined 2.8% to the performance. If we have a look at the Q1 versus Q2 attribution of the fund strategies, we see that in Q1, the main contributor have been these long implied volatility positions with a positive contribution of 5.4%, followed by credit protection plus 2.3% and active short biased equity trading with plus 2.8%. In Q2, however, the main part of the weight has been pulled by credit protection strategies with a contribution of 3.1%, as well as active equity trading plus 2.2%. At the same time, the long implied volatility strategies contributed a relatively minor 0.6% in the second quarter of this year. This is to show that at different points in time, the different underlying strategies basically are pulling more or less weight. So there is an intra-portfolio diversification of our long volatility strategies in the fund. And all other strategies have been positive as well, even though to a relatively lesser degree so far this year. If we go to the next slide, we actually look at the attribution across asset classes. So this is actual look-through data, looking at the underlying funds, at the underlying strategies, and adding up all the different asset class contributions. And here we see that if we treat volatility, implied volatility as an asset class of its own, it so far contributed 6% year to date in the first half of the year. Credit as an asset class contributed plus 5.5%, and equities as an asset class look-through contributed 5.3%. All the other asset classes, meaning rates, FX, and commodities, directional trading, contributed 2.6%. So all asset classes have been positively contributing in the first 6 months of the year. Here again, there is a diversification element playing if we compare Q1 to Q2. In Q1, the implied volatilities contributed plus 4.5%, clearly the best contributor, followed by equities with plus 2.4% and credit with plus 2.7%. In Q2, it's really been credit contributing best with plus 2.8%, as well as equities with plus 2.9%, whereas implied volatilities have contributed to a lesser degree. So all asset classes positive, and maybe to highlight, it's been very helpful for the fund's performance that we are really diversified across all asset classes, meaning we are not overly exposed to equity and equity volatilities alone, but we also have exposure to FX volatilities, rates volatilities, which have been performing really well so far year to date, as well as directional commodity trading, and not the least, credit protection. So it's really been the combination of all these asset classes enabling the year-to-date performance of the fund. If you go to the next slide, this is the longer-term performance of the strategy. And in the above chart on the right-hand side, you see highlighted in the green rectangle, you see the actual live performance of the fund, which has been launched January 1st this year. And you see that, as mentioned, the dark blue line, which is the fund line, is pretty much a mirror image of the MSCI World performance, which is the light blue line. And we also continued to basically outperform a passive long VIX strategy, illustrated here with the VIX-Y ETF in red. And what's maybe to mention also in terms of continuation of the strategy's performance with our fund is that the downside correlation to equities has continued to be significantly negative. So in the longer term, it's been minus 0.76, which is very negative, meaning very decorrelated, because of course we want to be negatively correlated to equities if and when they are falling. And that's exactly what this correlation number, this conditional correlation number, is reflecting. And also in terms of risk-adjusted numbers, illustrated, for instance, by the Sortino ratio, which only considers downside deviation, as opposed to the Sharpe ratio, which considers all volatility in its ratio. The Sortino ratio is very high with plus 3.1, and that's also a continuation so far this year. If we go to the next slide, we can have a look at the diversification benefits if and when the fund, the long volatility fund, is added to an equity portfolio. And here again, we see a continuation of the longer term strategy diversification benefits, meaning that if and when the long volatility fund is added to an existing equity portfolio, risk-adjusted returns tend to increase meaningfully. For instance, both the Sortino ratio as well as the MAR ratio, which is reflecting drawdown risks as a risk adjustment. Both of these risk-adjusted return ratios, they almost double if and when, let's say, 20% are allocated to the long vol fund for an existing equity portfolio. Going to the next slide, we actually go into the portfolio and positioning. So as an overview, as Thomas mentioned, currently there are 8 underlying strategies. The 8th strategies has been added on July 1st this year. And also with this matrix, namely the carry neutrality, which we aim for, that's still part and parcel of the portfolio. And then, of course, the expected returns in major drawdown scenarios, that's also very key to our portfolio construction. If we go to the current portfolio on the next slide, in terms of that the portfolio remains very broadly diversified across in long volatility strategies across both asset classes, regions, as well as styles. In the second quarter this year, we added 3 new strategies, bringing the total number up to 8, as mentioned. Of those 3 new strategies added in Q2, the largest addition has been a second complementary credit protection strategy. As you might recall, we already had a credit protection strategy in the portfolio from the very beginning. And now, as of May 1st, we added a second one, which is very complementary to the existing credit protection strategies. It has also significant positive expected returns in a credit and equity down market scenario, and it is also implemented largely with relative value credit positions. If we look at how the portfolio is structured in terms of different styles, it's really fairly balanced as of July. Implied volatility strategies count or add up to about 37%. Directional trading strategies add up to 37% as well. And credit protection, the 2 strategies mentioned, they sum up to 26% currently. And so we really try to remain as balanced, as diversified along different dimensions as possible, meaning in terms of regions. So we have meaningful exposures both in the US, North America, in Europe, in Asia, and also in terms of asset classes. We are fairly balanced across all major asset classes, as well as in terms of implementation. So we do have about as many strategies exposed to implied, meaning expected volatilities, as we have strategies being exposed to actual realized volatilities. So that's really key for us. Other than the quality of the underlying strategies, is really this multi-dimensional, robust diversification of the portfolio. It's the equivalent basically of casting the net as far or as wide as possible in order to be best positioned to participate in certain dislocations wherever and whenever they might happen in terms of region and asset class. If we go to the next slide, it's still another dimension. It's VaR. So how much VaR have you allocated? And here again, as with the asset class attributions, it's look-through data. So it's actual bottoms-up data provided by the underlying strategies, which we then assemble here on the portfolio level. And on the portfolio level, the VaR is currently somewhat lower than the longer-term historical average. So the 95% one-day VaR most recently was at around 0.65%, whereas the longer-term average has been more around 0.9%. And this has to do, well, with 2 aspects for the most part. One is a deliberate tactical temporary risk reduction due to certain trends changing, due to certain cross currents, and also due to rotations of various exposures, meaning profit taking on the one hand side of various strategies, as well as adding and increasing new strategies on the other hand side. And this process of changes often goes along with only temporarily reduced VaR. The other aspect affecting the current VaR is that on the implied volatility exposure side, in recent weeks and months, there has been an ongoing change or shift from more spot starting volatilities, meaning volatilities where the maturities start right now, to more forward starting volatilities. And those forward starting volatilities, they do currently come with a better risk reward as they are cheaper in terms of valuation metrics. However, they also tend to be, all else equal, they tend to be less volatile than spot starting volatilities. And this has the effect of, at least optically, decreasing the measured volatility currently. And here as well, in terms of VaR, as you can see on the below table, it's fairly balanced between the different asset classes. So as of now, the largest VaR allocation are equities with 29 basis points, and followed by credit with 17 basis points, as well as implied volatilities with 20 basis points. If you go to the next slide, we are already reaching the outlook and the current key themes of the portfolio. So how are the actual strategies currently positioned? On the implied volatility side, as I mentioned, there was this shift from spot starting volatilities to more forward starting volatilities, meaning, for instance, in interest rate volatilities, as opposed to buying a 2-year or 4-year maturity interest rate volatility on, let's say, 10-year or 30-year rates, it is now increasingly more the case that, let's say, only the segment 2 to 4 year is being bought and not the segment 0 to 2 years, because this is significantly cheaper trades at a discount to spot volatilities. Similarly, in equity volatilities, there has also been somewhat of a shift towards more forward starting volatilities recently. And here it's actually been interesting that in recent 1 to 2 months, equity volatility allocation have been increasing again. So in contrast to the earlier part of the year, where equity volatilities have been somewhat underallocated because they were not cheap even at the beginning of the year, now in recent months they have gotten somewhat cheaper again on various valuation metrics, so the allocation there increased again. And this is a mirror image to FX volatilities, where the allocations have decreased in recent months because valuations are not cheap anymore. And as always, this can change if and when relative valuations change again. And also to mention, for equity volatility, this really seems to be at least one of the elephants in the room, as it's now really a question. And you can look at the chart here on this slide. You see in light blue, you see the 2007 to 2008 episode and how that played out in terms of the equity evolution on the left-hand side, and in terms of the VIX evolution on the right-hand side. And then the dark blue line is the current episode, meaning that 2022 year-to-date performance. Again, on the left-hand side, the equity evolution. On the right-hand side, the VIX, meaning the equity volatility development. And here you can see it fairly closely tracks, so far this year, fairly closely tracks the equity downfall in 2007. And also on the VIX side, on the right-hand side, the evolution even more closely tracks the evolution of the VIX back in 2007. The crucial question now will be whether or not there will be a second leg down, a so-called second leg down of the equity indices, as there was in 2008. And by that implication, a real boost to equity volatility, as there was in 2008 as well. On the right-hand side, as you can see, in terms of the explosion of equity volatility going from a 20 to 30 range up to 70, 80 at peak. And this is really one of the, I think, fairly interesting potential analogs in terms of how equity volatility could evolve going forward. Credit, that's the second elephant in the room, as we call it. Because as you for sure all know, in recent years, or even the last decade, there has been lots of corporate debt added. So metrics like corporate debt to EBITDA, they have been steadily increasing, and credit quality tended to decrease during those boom times. And now we have a situation of of increasing and rapidly increasing interest rates, as well as a slowing economy, as well as increasing costs in terms of labor costs and commodity costs, basically hurting margins. And so credit, which really seems vulnerable and has already sold off, could potentially sell off even more if those different forces are hurting credit quality at the same time. Yeah, and on the directional equity side, last but not least, in recent weeks and months, short exposures have been somewhat trimmed. However, that's only tactical, and they could get more short again on say a larger rebound. That's all from my side, and over to Thomas.
Many thanks for the insight, Daniel. To summarize, we are very happy with the performance, with the momentum and the opportunities we see for the strategy. Please do get in contact with us if you have any questions or if we can be of any help. With that, let me thank you for your attention and for your trust in us. We wish you a pleasant summertime and look forward to connecting again soon. All the best.